Hey guys, you're welcome to the call. It's actually a Q&A session, which I just thought to myself to do, because I felt like a lot of you might maybe not understand how I do some things and are interested in, I get questions and people are interested in what I do, but some of them don't really know how I go about it, so that's why I decided to give an open floor to people who, had questions, so they can go ahead come forward with your questions, and then I can give like a comprehensive answer, which I also felt could be beneficial to everyone else who's also trading. I feel like we can all learn from potential answers that I may give. Anyway, so I'm just gonna go. There are 9 questions here. I'm going to go over them as much as the call. There's no time limit to the call, so I'm going to be here for as much as you guys want me to as well. So if you have any questions along the line, you could send into the chat box as well, and I'll go over it. So someone asked, will you upload it? Yes, I will. I'll upload the recording. That's why I'm recording it as well. All right. So the first question here is a question from someone who asked, how can a 9 to 5 benefit from Forex? So here's my own personal opinion and my own answers. So I feel like for this question, we have to look at the factor behind how this can be beneficial, since that's what the question is about. So the factor here is time. And it's about, how do you structure your time compared with compared to the best time to trade your pair, or to trade the pairs that you would trade as much as you're doing a 9 to 5. So say, for example, you wake up in the morning, well, my time, because I am using GMT +1. So it's probably going to be a different answer and a different concept for different people, because we're also not on the same time zone. Everybody in the world is on different time zones. So there's going to be, I'm probably going to try as much as I can to actually give an answer to both perspectives, So for myself, 9 o'clock in the morning, obviously we go to work, and then 5 p.m. you come. Okay, I think it's actually about 9 to 5. So it's about your work and your job. So the idea is this: in the morning, for me, when I wake up in the morning, is actually London session. So 8 a.m. my time is when London market opens up in the market, and then it's like that 8 a.m. is usually the time where I'm probably driving to work. So, you probably might not be present on the charts, which means you would not have the opportunity to maybe go break even or be in control. I think I'll just use the word control. You would not have so much control and enough balance psychologically, because you're preparing for 2 things at the same time, except you can do so well simultaneously, multitasking simultaneously. But I feel like it's going to be a thing where you're going to have to find a balance. So if in the morning you're preparing to go to work, and then London session is opening, then it means that whichever pair that you're going to trade, you don't want to trade, in the mornings. You don't want to trade in the London session. So pairs like JPY, for example, would not be a pair I would advise in 9 to 5 who is on my time zone to actually go to trade, because it's like you're not going to have so much control, over some uncertainties that could happen in the marketplace, regarding managing risk, regarding just regarding knowing, just having a psychological balance and being prepared for anything that may happen because of the time frame. Now, the thing you can do, because I feel like people who have 9 to 5 also have, like, there's a break time, there's lunch, right? So you could have that as the substitute, whereby you can now have that control. Even I don't think it's even enough anyway, because how long is lunch anyway? You should probably have like 2 hours. Well, for my style, I feel like maybe day traders probably, they can do it effortlessly, because you really do not need so much time, right? That's maximum 1 hour or 30 minutes. Then you can do in your lunchtime in New York session, which is around 1 p.m. They're about my time. Now, for other people who are like US, people who are from America, who wake up, New York session in the mornings, and then you're going to do a 9 to 5, it's actually the exact same thing. So you preparing to go to work is actually the same time where New York session, which is actually the best time to trade. So I feel like for those people for people in America who are, New York session time zone, they are probably going to have it the hardest because there's not going to be so much, freedom. You're not going to be in control so much because you're preparing for other things, which is your job, right? You're trying to go to job on time, get dressed, get baited, and all these couple of things. It's not a nice I would say avenue to want to say, okay, you know what, I want to trade, because I feel like when you want to trade, you should actually be prepared to trade. You should actually be ready to trade. It's not just trading with vibes, so I feel like for that, you're going to have to find a balance with your timing, and then it's about just looking out for what's best. So somebody who wakes up in the morning, I would say, okay, and maybe in the midnight, you probably should trade GJ or trade pairs that move mostly in the New York session, in the London session and the Tokyo session, because maybe then you're done with your 9 to 5, so it's about striking a balance and then looking for the pair that also exhibits the best characters during these certain times that you would have freedom, to trade. So it really is about managing that your time, I think, and then finding that balance. And then once you find that balance, then I think you have that figured out. You have that problem solved with combining a job and combining your trading, whichever style or whatever you do. So yeah, I hope that answers the first question. And that's my opinion anyway. The second question is, what are your confirmations for choosing strong supply and demand? And what are the things you look out for? So I'll just rephrase the question. So the question is, what do I look out for to say, okay, I'm gonna enter a sell here or a buy here? I think that's the best way to rephrase the question. So it really is about, okay, so my style, because everybody's style is different. So my style is in such a way that I don't market execute ever. So all of my trades are limit-based entries. And what that means is that I come to the markets, I look at the charts, I mark up, and then I arrive at an analysis, and I arrive at points where I can say, okay, this is what I'm going to buy and this is what I'm going to sell. And then I set a limit there because I anticipate that there's going to be a reaction. All right. I don't know if the reaction is going to be good or bad, but based on consistency in what I have found this kind of entries to do, aka supply and demand, then I just go ahead and put full trust in them. Now, the idea of the question now is, what are those things I look out for to say, okay, I'm going to put all my trust in this supply zone, or I'm going to put all my trust in this demand zone. Now, everything else, I'm going to give you a very, very simple sketch because it's all about logic. So say, for example, we have a bearish market. I'm going to look at two perspectives, bearish markets, bullish markets. Now, if this is a bearish market, for example, I can simply see the structural patterns. Structure, what I look out for in the market is structure, liquidity, and supply and demand. So these three things are, I think I also did a call where I went over the three things I look out for in the market. So structure first. So I look out to find out if I'm in a bearish market or a bullish market, for example. So see, this one right here is a bearish market. So regarding structure, there are two things I look out for. One, where's the zone that continued the structure or created the structure? And it has to be unmitigated. And two, where's the zone that broke the previous structure corresponding, it has to be unmitigated as well. Like then when I find the zones, it's not even like you're going to look out for them. You just have to look at the charts and find out what is unmitigated at what created the structure, or what is unmitigated at what broke the previous structure that created the opposite structure. Simple. And once I find these two things, I go ahead and set my limits. It really is that simple. And I obviously will do this on a higher time frame, because the higher the time frame, the stronger there's a likelihood that you find more consistency in getting any entries. I don't care which one works, because anyone can work. But the idea is that I make sure that I prepare for both case scenarios. But there's a high chance that when one of them works, structure will continue. And if I get my entry here, my exit is here. If I get my entry from here, my exit is here. And really, it's that simple. Same way I would do the bullish markets, a bullish structure perspective, whereby this is the bullish structure, and I just simply look out for where's the zone responsible for breaking the structure and where's the zone responsible for creating the structure. And there you go, I have my demand zones ready. And I can just go, when price makes a retracement and comes back down, my limit is set and my exit is right there. Or price comes back to the zone here and my limit is set and my exit is right there. Also, there are times where when I see that this is going to create a retracement towards my zones, I take a hedge, sell, just in case both of them are also wrong, because as we all know, anything can happen, in the sense that price could break structure and change direction. So in that case, I'm already in the change of trend without even waiting to jump into the trend. So that's really how I do it. It's about structure, liquidity, and then you find the supply and demand. Okay. Now, question 3. So question 3 says, do you ever have doubts that your system would stop working or something would happen that would impede your progress? Basically, do you get anxious when there's no visible reason to? If so, how do you deal with it? Do you ever have doubts system? Doubts? No. So the idea is, I am now in a position, I am personally now in a place where my system is 100% tested. So my system is never the problem when I'm wrong. When I'm wrong, sometimes it's just because I can be wrong. And when I'm wrong, maybe I made a mistake, So it's not the system's fault at all, ever. So I feel like because of the understanding towards that, I no longer have any doubts about my system, whether it's going to work or it's not going to work. It's just about following the principles of the logic behind the system and applying it and understanding as well that it can work some days and it won't work some other days. But the days it will work would be very nice, and the days it won't work would also be very nice, knowing that I'm going to manage my risk effectively. So that just also takes out the anxiety behind my system, understanding. It's about understanding. When you understand, then taking action becomes easy to do. The moment you can rewire your brain and allow your brain to understand that this is actually how it works, the moment you understand it, then taking action becomes simple. I think for me, that has been the bridge from being anxious before and having doubts about my system to now being in a place where I'm like, yeah, I just take my actions, because I already know some days are going to be, some days it won't work and some days it will work. And the days that it won't work would still be a good day, because risk will be managed and it will be a small loss. The worst that can happen is a small loss. And if that's going to be the worst outcome, then everything else is going to be taken care of, basically. So that, I hope that answers the question. It's the understanding, it's the mindset thing. So the question number 4 is, thanks for taking your time here, you're welcome. So the question is about ranges. How do you identify ranges on the charts, both on the lower time frame and the higher time frame? Because it says sometimes it gets confused because there can also be different types of ranges. And he talks about Y curve, and it's hard for him to identify them. Okay, so I personally do not care about Y curve. I don't give two fucks about accumulation, distribution. I don't even use it. It's none of my business. And I don't think it should be your business as well, because, you can never guess what the market is going to do next. So trying to think, oh, this is an accumulation, or oh, this is a distribution, or oh, this is a reaccumulation, or distribution is a waste of time, because it could be anything. That's not what you should be preparing for. What you should be preparing for is outcomes. So I feel like now the question again also talks about, how do you identify ranges? So last time I did a call speaking about what I look out for and my ideology behind the market. There's also a recording, I think, on the Telegram. And I made mention of timeframes, being a criteria as well. And I spoke about how higher timeframes are greater than lower timeframes, in the sense that the higher timeframe point of interest has a higher chance of reacting positively in the direction that you anticipate it to, compared to a lower time frame reaction. And that's because, price, life and markets is about long term. It's not about now. It's always moving. So if you can know the structure of a long term, there's a high chance of gaining a whole lot more, from that. So I feel like with identify ranges, you have to come to a point where you are able to see that you can trust the higher time frame and put the risk on the table on a higher time frame, and you can find a way to create a favorable risk to reward ratio as well. Of course, I'm not going to tell you how I do mine, because you don't use my system. Everybody's system is different, but you are going to have to find a way around your own personal system, a way that you would trust higher time frame a lot more, and then put the risk on the table. Because I feel like the main reason why people go into the lower time frame, excluding the main reason why everybody actually goes into the lower time frame, aside from the fact that it moves faster in time, is also I think that would be the main thing, is the fact that it moves quick in time. But what you're looking for is not speed. What you're looking for is consistency. So the moment you actually also understand that, okay, consistency over what's quick and what's not quick, because that's what is more important in trading. It is consistency. So you're going to find consistency from trusting higher time frame a whole lot more than lower time frame. It's something that I also personally had to, it's not something that happens overnight for sure, but it's something that you're going to have to get used to. And I think that also comes from setting limits on the table rather than market execution. It comes from the style, because a person who market executes from a 4-hour point of interest that has 60 pips stop loss if you entered off the entry, the open. So say, for example, this is the range. This is on a monthly time frame. But let's say this is a 15-minute time frame and this is the range. And I get my entry here and my stop loss here. And this entire range is about, let's say, 70 to 80 pips. So that would mean that if I enter up here, I am risking 70 pips. And that also means that if I want to actually gain anything on that trade, it has to be 70 pips or more, And that comes to a point where you talk about risk to reward. So somebody who is market splitting takes a buy right there, and then he waits until it is 70 pips for him to get to 1-to-1, while his stop loss is, right there. So it takes away the joy of market execution, because I know market execution is a whole lot more beneficial when you're in a lower time frame, when you're like the 5 minute, the 3 minute, the 1 minute. That's when you actually truly want to market split, not when it's on the 4-hour, right? So, or the 1 hour or the 2 hour, which actually is truly the only place you find consistency anyway, at least for my style. Anyway, especially if you're looking at ranges and impulses, so small ranges, 3-minute time frame ranges, you probably would not find that consistency when you're looking at positive reaction. But 15 minutes, 15 minutes is even very small for me. Let's say 1 hour, 4-hour ranges, then I can say, okay, yes, as much as I can keep going for the 4-hour ranges each time, I'm most likely going to get a much more positive outcome than somebody who's taking 1 minute ranges. I think I would have a better risk to reward ratio and a better win rate compared to somebody who's doing it on a lower time frame. So I think for me, it would be you have to come to a point where you focus and trust around your system that higher time frames give more consistency than lower time frames. So that was the end of that question. Okay. Number 5, the question says, what were the first 2 years of a trading journey like? What were some of the mistakes and challenges you faced? And how has overcoming and learning from those challenges made you a better trader today? The first 2 years of my trading journey, I'd say it was the year where I made the most mistakes, and I'm grateful for it. It was the year where I allowed myself, where I was open to making mistakes. I think from the first year where I lost the most money I've ever lost in my life, which happens to everybody, I believe. From that first year, I think I maybe had a turnaround in the sense that the money I lost was a lot, and it wasn't even mine. It wasn't even my money. I was trading for someone at that time. And you can imagine losing, it's easier when you lose your money compared to when you actually lose someone else's money. It's a different ballgame, right? So imagine the pressure where it's like, okay, how do I get to a point where this never happens again? So it had to put me to a point where I told myself that, you know what, I'm going to do this the hard way, and I'm not going to take any shortcuts anymore. And from that moment where I decided to do things the hard way, I think that was the best decision I ever made in my trading journey, because that put me in a spot where I was open to failures. That put me in a spot where I was open to lose. I was so happy to lose, because I felt like I knew within myself that I was still a baby. I did not allow the ego or the pride come over me, making me feel like, oh yeah, I made it. I always knew that, yeah, there was so much more to learn from my mistakes. And I never allowed my mistakes or my failures or my losses make me think that I was a shitty trader or whatever. Because, when I hear stories from other people saying things like, oh, it takes 5 years for you to graduate from university, it takes X amount of years. And I mean, like, a lot of time. So it made me feel like, yeah, I'm still in the growing phase. I'm still in the learning phase. So my mindset then, it was in a point where I was building myself, and I'd say those mistakes, those challenges, I'm forever grateful for them, because they've led me to the point where I am today. So yeah, that would be it. Okay, so what were the mistakes and challenges I faced? So what were the mistakes I made? I have to think very well about this one. Okay, so I think the mistakes I made from the very first time when I lost the most money would be when I realized that I must always use a stop loss. And ever since then, I've never not used a stop loss. I think that was one challenge for me, because when I started, I felt like I could read gold, and it was gold as well. I felt like I could read gold so well at that time, and it was actually very volatile. If you guys remember, I think that was maybe 2019 or so. And it was a volatile period. I think it was around here. Somewhere around here. It was a volatile period also. I think it was also maybe not so much volatile, because I see so many ranges here. But yeah, that was pre-COVID, basically. And that was the market preparing for the impulse when the COVID hit. So I would say there was a time when I put a seven lot size, I'll never forget, and I did not use a stop loss, and it was early in the morning, and I was before then, I was probably up about maybe 15% on a 5-figure account, and it was big money for me then. So I would not say I was a greedy person. I'm never really a greedy person anyway. So I put a 7 lot size, and there was no stop loss, and I saw the market go against me in a way that I could not control my emotions, and in a way that I could not control anything. I could not even do anything. I was stuck, because it started growing from 3,000 negative to 5,000 negative. And I kept telling myself, it's a reverse, it will go back down. And the market just kept on going against me in an impulsive way. This is not a range anymore. Now, this is an impulse. So imagine coming into the market and there's a range going on, and then the range has elapsed and it's now time for an impulse. And that's where you decide that, okay, let's say this is a bullish range preparing itself to make a bullish impulse. And then I sell maybe 15 minutes just before it's about to make its impulsive movement. And I don't also use a stop loss. So what happens then? The impulse takes away, makes me get into a point where I start to think psychologically that it's going to go down, it's going to go down. Maybe just when it's just here, I start to think, oh, it's not so much, it will come back or reverse. And forgetting that, or not even knowing that that's an impulsive movement. And I just keep seeing it move up, and I just see, So from then, it was that moment I told myself that, you know what, I'm always going to use a stop loss no matter what happens. And I stayed disciplined to it. And now I can never imagine myself not use a stop loss, to be honest. I always use stop loss. So I think for me, that was one of the mistakes I faced, and then I've obviously not done it ever since. I would not say that, okay, one challenge I faced was the challenge of, actually, this is a very, very interesting thing. Let me speak about what I'm facing right now in my trading journey, rather than what I faced before. Now, what I'm facing right now in my trading journey, I'm now in a spot whereby what I have to do as a trader is make sure that when I create a plan, I must, emphasis on must, I must set a limit on that plan. I don't care because I don't know what that plan is going to do, but as long as I created the plan, I must set a limit on that plan. Now, that's the challenge I'm facing right now in my journey. That is as a result of the fact that I realized that I never really can tell which supply or demand zone is going to give me a positive outcome. You can never tell. So if I do not set a limit, what I've done is I've put myself in a place for self-sabotaging beliefs. I've put myself in a spot for doubts. I've put myself in a spot for hesitation. I've put myself in a spot for fear. Because if I don't put the risk on the table immediately when I have a plan, what I've just done is I start telling myself, okay, let me see. I want to see if it's going to get there in the right time. I want to see if it's going to get there in New York session. I want to see if it's going to get there in Tokyo session. And the thing is, it can get there anytime. You can't tell. Price can react into that zone 5 times. It can react into that zone in Tokyo session, and it can come back there in New York session, and it can come back there the next day in, my style, and it really is about just understanding that, just put the risk on the table and make sure that you allow it work for itself. It's not about me saying, oh, I want the market to work like this. It's about me just putting the risk on the table and then just seeing what happens. Because eventually I realized that when I make a plan, even if I lose the next 3, there's one that's always going to work. There's one that's always going to work massively well. And it's all about just putting the risk on the table. That's how I would have won that one that would work massively well in my series of trades. So it's like, if I start to pick and choose which one I'm going to set a limit for, which one I'm not going to set a limit for, it's like I'm taking the potential outcome of a positive, reaction to a control supply or control demand that I have planned. So it's like, what, right now, I'm like, every plan I make, as long as it is backed by the system, I make sure that I put the risk on the table. I don't care, I don't care what the outcome is going to be, basically. So that for me was a challenge. And right now, all I'm just doing is making sure that as long as I have the plan, I just make sure that I take action immediately. I don't even have to wait for the next day before I take action. I just do it immediately. So I don't put myself where I hesitate and then it works and then I start regretting. And that's even worse, because that's worse than losing, to be honest. Regretting and missing out on the plan which you already had. And that puts you And then you find yourself taking a plan which you just prepared just at that moment, and you lose. And then you ask yourself, I could have just put this loss, which I thought I would lose before. So it's like I've found a way. I used to have that challenge, but now it's like, you know what, just take the action and it will work for itself. So yeah, that is one. So question number 6, what is your confirmation entry when price gets to your point of interest? I think this is the same question with this one. Yeah, that's the same question. So I'll just go to question number 7. How can a trader be disciplined? How can a trader be disciplined? I don't know if I actually have the answer to the question, to be honest, because of the fact that everybody is different. So there are different ways to people. My personality is in such a way that I'm a very carefree person. I live my life. I don't live life like life is anything. I just live life, and I'm just grateful for it. So I try as much as I can not to expect so much from life. I'm just here for a limited time anyway. So I feel like because of my personality, it allows me to do things in a certain way. And I feel like every other person will do things differently. So that's why I think I might not have a question. I may not have an answer that will suit your personality or suit each individual on this call, because it could be different for different people. The way I may be disciplined might not be how discipline would work for you, So I would say the answer for that question varies. So I don't think I can answer that question about discipline. So I'll just jump to the next question. Do you have doubts? Okay, that's the same question. I think that's the same question. Yeah, that's the same question. So question number 8 is the same from number 3. So number 9, what do you think you look at before you trade? I think I've explained that. Can you explain CD and CS? And is it all of them that work? No, not all of them that work, obviously. And I also think I've explained CD and CS. I just did a sketch. So that sketch I did, that was CD and CS, basically. That's just supply and demand. Supply and demand is just simple in the sense that supply or demand is just what sweeps liquidity and what breaks structure. Simple. That's just it. What sweeps liquidity, what breaks structure. That's how you find supply and demand. I noticed sometimes you give 2 calls on a setup. That's very good that you noticed that. Usually the first may not play out, and sometimes the second play out. Is there something that you see? Is there something that you see happen that increases the confidence of a setup playing out? I want to be that, please. Let me try to understand the sentence. Okay. I don't understand this sentence, but I'm going to explain this one. So yeah, I actually always prepare for, remember how when I drew the sketch, I showed you 2 points. That's actually it. Now, there are also times where in a point of interest, I spoke about how a POI can be 70 pips, 80 pips with the range, right? So if I take 80 pips from the entry, then it means that my reward has to be 80 pips or more. And that's going to kind of stunt my risk to reward and make me reduce my lot size and make me not benefit from the potential outcome of that trade. So instead, what I do is I split a point of interest into 2, which is instead of risking 80 pips, I can, if I divide it in 2, I'm now risking 40 pips. Now, I'll also give you the mathematical calculation on what the outcome of that, because it's not just the idea, there's also a mathematical risk to reward behind it as well, in the sense that it increases your efficiency. Now, this is it. So say, for example, I have 60 pip stop loss. Yeah. So for example, I have a POI that has 2 pip stop loss. Now, I always tell myself that before I get into trade, which is one of my plan, I don't get into a trade that has anything less than a 1 to 10 risk to reward. So for every trade I take, it has to be 1 to 10. Now, it does not mean that I'm risking 1%, okay? Just so you understand. So 1 to 10 means that if I'm risking 60 pips stop loss, I want to get 600 pips target, right? Which is actually my style. Everybody's style is different, okay? Actually, this isn't like my trading anyway, because I try as much as I can to, well, there are cases where I have a 60 pip stop loss anyway. I think I even had one last night. Okay, I'll just do it this way. So if I have this, because this is like the criteria now, it means that if I take, say for example, a 0.5% risk on that, and I win it, I'm going to make 5% on that trade. But 600 pips is a lot to catch in the market. It might take some time, right? It maybe might take you 2 weeks in the market. For gold, it will take you like 2 weeks. For USD, for USD, it will take you like 2 months. You know, so because of that, because of time, what I do is I decide that, you know what, instead of risking 60 pips, I'm going to risk 30 pips each and have 2 entries. Now, this education I'm giving you guys is not supposed to be for free. But yeah, you're getting it for free. So 30 pips each. And now what that means is I can now target a 300 pips risk to reward. I can now target a 300 pips instead of 600 pips. Now, because now it is still the same 1 to 10 risk to reward anyway that I've just done. So what that means is now I'm also prepared for the case where I lose both. Because it's the same thing, right? If you lost your 60 pips here, you still lost your money anyway. So if you risk 0.5 pips on 1 to 10, you still lost the 0.5%, right? So what I do is I can now decide that, you know what, maybe I'll take 0.5% for each of them, all right? That increases the risk to reward by doing that. Or sometimes I can do 0.25, but I think the best is just saying, you know what, I'm going to say, okay, I'll take 0.5% on this one, I'll take 0.5% on the second one. By doing so, I've risked 1% for 2 trades, 0.5, 0.5, but I've increased the efficiency on the outcome of both trades. Does that make sense? Now, there are also times where price will react to my first entry, and it can give me an avenue in a way that I can see something based on my market experience, and I can tell myself that, okay, you know what, I'll go break even. And when I go break even, there are times when price can even break me at even and take out the opposite, the stop loss just above. Now, what I've just done is instead of losing 1%, if I was going to lose everything, I've now lost only 0.5% as a result of that. All right. So it also gives me control for my trades on each trade, where I can also manage my loss. You know, rather than lose 1% when I split 1% on 2 trades, I can even manage. There are times when I can even manage both trades. There are times when I break even on both entries. Maybe this entry gives me a positive outcome. It gives me a way to break even. I break even, but it comes back, breaks me out at even, reacts on the second entry. I still find a way to break even. It comes out and breaks me out at break even, and I end up losing nothing as well. You know, it's rather than, so it's like, it's different when I just have only one trade and I break even on that one trade. If that trade goes out, that's the end of that trade. You know, it's like I'm just leaving control to just one trade. There's only so much I can do with one trade, you know, one entry, but there's a lot more I can do with multiple entries rather. So it's the idea of not putting my egg in one basket. How do they say? Yeah, not putting all my eggs in one basket, is spreading it, you know, and increasing efficiency as a result of that. So I hope that makes sense on that question. So that's how I do it. That's why I have 2 entries for a setup. It's just to increase the risk to reward efficiency. So yeah, I think that's the end of the, okay, so there are private, some people are sending me direct messages. So you guys might not see them in the chat box. There's actually just one anyway, so I'm just gonna read it. The question is, was there a point in your Forex journey where you feel like you already had the knowledge of what other mentors show, but yet are not profitable? Was there a point in my journey where I felt like I had the knowledge? No. My answer to the question is no. Let me see if I can bring the question up here so everybody can see it. All right. So the question is, was there a point in my journey where I felt like I already had the knowledge of what other mentors had, but I was not profitable? I don't think so. One thing I never did personally was, or one thing I never do is compare myself with any trader or every other person, because they are not on my journey. My trading journey is private and personal, and my Forex journey is not, I'm not in competition with anybody. I'm in competition with myself, basically. So I don't really care about anybody else. I don't care about anything. So I don't really look at anybody else to now look at myself. So I think that's how I answer the question. I don't care what you do. I just care about what I do. I just focus on what I do. You know, because I'm the only person who can make myself profitable. So I just focus on that, how to do it. How do you overcome greed, especially when there's pressure to make money? How do you overcome greed? You overcome greed when you start to look at trading from a risk to reward point of view. When you put risk, when you think of risk, greed is out of the picture. People who are greedy do not understand risk. That's why they're greedy. But when you have risk in mind, then you take out risk, you take out greed. I think that's the best way to answer it. When you understand that risk is involved in trading all the time, then you're going to understand that whatever outcome is based on the risk you put. So that would in turn make you understand that, oh, because I'm looking at the risk I put on each trade, you will never get greedy, because you understand that, you know what, if I over risk, I know what's going to happen. I know the potential of what could happen. Even if you do it once, it's like somebody who's trying to abstain from smoking cigarettes, and it's like, you know, oh, I'm not an addict, or I used to be an addict, and then I'm gonna say, okay, maybe I'll just smoke once a month. It's like saying, okay, maybe I'll just over risk once a month. What if the time you do it is the time the market's like, you know what, you never learn. How do you handle losing streak? How do you handle losing streak? Risk actually helps me handle my losing streak. And I'll explain. Everything I do is such in a systemic manner, because I don't, like I said, I don't market speeds. So my risk to reward is everything I do is calculated from the beginning to the end. I calculate everything. So when it comes to risk to reward, and when it comes to trading for a monthly perspective, let's say I take 15 trades in a month. And I understand that from the start of each trade, so I'm gonna have trade 1, trade 2, blah blah blah. You get the logic. Trade 3, and just do 10 trades, so you guys can see the psychology. 7, trade 8, and it keeps on going, right? So now from trade 1, here's something that I always look out for. So I'm starting a series of trades. I obviously do not want to start too big. So from the first 2 to 3 trades, I should not risk more than 1%. So I can take 1% and I can split, or let's say 2%. I can split 2% from the first 3 trades. So maybe first one is 0.5, second one is 0.25, third one maybe 0.5, that's 1.25. Okay, let me make it 4. And the fourth one is another, let's say 0.25. So that is 1.5% on 4 trades. So I try as much as I can to, there's one thing I do, and it also depends on the setup as well, not just the trade, but the setup. And what I mean by that is it a continuation trade or is it a counter trend trade? When I trade against the trend, I reduce my risk because I understand that there's a high chance that the trend could continue. And because I'm trying to trade against the trend, I could lose. So what I do instead is reduce the risk. But if it's a continuation of the trend, then I increase the risk, because why not increase it anyway? Since there's a higher chance that it will continue in my direction. So that's why this is like this. So it depends on the setup. So I try as much as I can to make sure that the first 4 to 6 trades do not exceed 2%. I try my best to make sure that the first 4, because in my head, I already assume that I'm going to lose all of them. So if I lose the first 6 trades, I do not have the psychological barrier to not take an action for the next trade. I do not hesitate to take action on the next trade. I do not also have greed to come back because I've lost so much, and I want to come back and break even. So I try as much as I can to make sure that when I'm starting a series of trades, all right, when you're starting an account, I try as much as I can to make sure that the first, the first 4 to 5 to 6 trades on that account, I do not risk too much so that I can give leverage for growth when that win shows up in, let's say, 1 to 10, or let's say 1 to 7, or in 7 trades, I get that 1 win. I feel like there's 100% chance that I will win a trade in 7 tries. I personally feel like there's 100% chance that I would win 1 out of 7. And so in that case, when that trade wins, it covers up for loss and then also makes me profitable. So if I just get 2 or 3 out of 15, I am good to go. All right. So because of that, that's how I handle losing streak. So that if I lose 6 times, the first 6 trades, I lose it. I'm not feeling like, oh, I've just, because imagine if I risk 1% on each trade, it means that I'm 6% down. I'm 6% on drawdown, and 6% drawdown psychology is different from 2% drawdown psychology. I'll tell you that. So I try as much as I can to make sure that I do not start big so that I can give myself room to grow. And then when I'm in the middle of it, I can decide to even go 1% risk or go higher, that sort of thing. So that's how I handle it, is to handle my psychology by starting small, then increasing it as time goes on. Does that make sense? I hope I answered the question. So the next question here says, can you explain CD and CS and what makes the one that play out? Okay. Let me give you to answer this question, because I answered it already. But to answer this question, let's look at the charts for a second. So maybe I'll just go to the 1 hour time frame. So I'm going to use this area. Let me use a different pair, sorry. So I'm just going to use this zone to explain the question about control supply and control demand, just so that it will make sense. So I look at structure, like I said, first thing, structure. You have this low, you have that high. Now, what that in turn means is that there are only two zones of supply, meaning that the first zone of supply is the zone responsible for sweeping structure, sweeping liquidity. And the second zone of supply is the zone responsible for breaking the opposite structure of what swept liquidity. Supply zone, supply zone. Go ahead, set your limit. Target. Entry, exit. You've made your money. I don't think it's really that difficult. It's just, I don't think too much. It's not something that you have to think about. It's just straightforward, to be honest. That's all. Like that really is it. So structure continues here. You can even follow it. That's the zone responsible for sweeping the liquidity. Limit there. I don't know how you do it. Maybe the 50% stop loss there. Exit here. You made your money. Simple. It really is that simple. It's not like I have a magic system. Entry there. Look, structure high, structure low. The zone responsible. Simple. Even if I lose the second one, but in this case, there's no even chance for the second one. You continue. Structure there. I don't know if this is structure. You can say that's the structure or this is structure. I don't know. But the main thing is this is the zone responsible for breaking structure, right? Right there. What happens? Entry, exit, make your money. I don't think too much about it, to be honest. Structure. What happens in this case? Break a structure. Okay, so if there's a break of structure, there are only two things: the one that swept liquidity and the one that broke structure. The one that swept liquidity obviously did not work, but what worked? The one that swept. Simple. Entry, exit. It really is just like that, to be honest. Supply and demand. That's just it. It's not like I have a secret source or whatever. That's just it. That's just control supply and control demand. Just go there, set a limit. One will work, one will not work. And that's just the reality of trading. Can you explain real structure? Can I explain real structure? Structure is what sweeps liquidity and what breaks the opposite structure. That is structure. I don't know if there's another way to explain structure. What sweeps liquidity and goes in a direction for a long time. That structure. It's kind of like a structure can be defined in so many ways, to be honest. But I'd say because sometimes liquidity too can be structured. Structure can be anything. Structure is actually high or low. So it really is about the long term. I think that's it. It's instead of looking for a 3-minute structure, I don't do that. I look for a 4-hour structure or a 1-hour structure because they are stronger. So I think that for me is structure. Structure is when you look at what's the pivot high and pivot low in a big time, in a long-term picture, because it's about the bigger picture. So where's the body? Where's the playing field? Where's the pivot high, pivot low? And somehow with practice, you just have to find it. You just have to understand how to, I'm not going to teach you how to find it, obviously. You just have to learn how to find it. It takes practice and rigorous trial and error, So yeah, that is it. Any other questions or that will be all? Okay. Someone asked me to explain demand and supply. I thought I just did. That's why I laughed. I actually just explained demand and supply, to be honest. With your model, how do you pick trade from an intraday perspective? I'm not an intraday trader. So I hope that answers the question. I don't day trade. I trade where the market is going. So the way I trade is I trade in such a way that I want to be with the market. I want to trade alongside the market. So I trade in the long-term direction. So what that means is, so this is a pair that I don't trade, but I actually marked it out for someone, and I marked it out before I even reacted here. It has already reacted and the person has made money off of it. But what I mean by that is I would have my structure body, first of all, and then I would have the zones that sweep liquidity and are unmitigated. And I will only just wait for them. Simple. I would not do anything here at all. All of this are none of my business until price comes there. So that's how I trade. I trade based on what I'm meant to do with how I do. Not all of this, none of my business. So that means I would not day trade. So this is actually my business right here. I only trade the edge of structure. I don't trade the middle of structure. None of my business. That's my money move. So I should not be trading when my money is moving, right? I should trade and allow my money move. So that's how I trade. So I don't just trade anyhow. I trade how the market moves. Can you use your style for pro firms? Yes, I actually purchased the prop firm accounts today. What are the odds, right? So yes, you can. It all depends on how you do it. There are so many times I have seen that price has given 1 to 10s with gold, with my system, in a monthly perspective, sometimes 2 times, sometimes 3 times that I could have taken. So it's like, why not go for it? So yes, it does give me you can trade it with prop firms. Everything is all about how you plan it. As long as you can create a plan and then carry out that plan, you should find yourself succeed, I'd say, especially with trading, because the most times that you would not win is because you hesitate, not even because you maybe took the wrong trade, because you hesitated to take a trade that you already had planned out. So I think for me, that's just what I want to do. I just want to, just set limits on my prop firm account and just allow the trades work for themselves. Really, for me, I do things in a very, very simple way, to be honest. So I try as much as, because trading is very, very complicated. So as much as I can to make it simple. Just A to B, A to B, A to B, do this, do it, just do it the exact way. And it's like a robot kind of way. So that's how I do it. I trade like a robot, basically. So yeah, any other questions? If there are no more questions, I would be wrapping it up here. As you guys can see, I have these plans mapped out and I already have limits set on them to trade them, because I feel like they could give me a positive outcome. So we'll see. By the way, NFP is this week, and what else is this week? Interest rates. It's a very, very volatile week. So I feel like it's going to be an interesting week, to be honest. A very volatile week. So hopefully it goes the way I plan, and I would share what I think as well as the market moves with you guys. But yeah, I'm patiently waiting. So we'll see. You want to understand CD and CS. You could go over the Telegram here. There are videos which I did, which I think if you watch it over and over and over again and then practice it, you probably might learn it, because I actually do not teach people anymore. But you can go over it and you can learn it. Yeah. All right, guys. So take care. I'm going to send the recording for you guys as well. So you can go over it if you want to. A question here says, does fundamental affect your analysis? Everything is put into consideration, I would say. But no, the answer is no. Yeah, it does not affect. It could affect it negatively if it could, right? It could affect it negatively. Anything can happen as we're enough. So it could affect you negatively. It could affect you positively. I don't know. Anything can happen. I would say it's not something that I would say I rely on. Okay, so I think the one thing I make sure that I think I should start doing when it comes to fundamental analysis, because to me, fundamental analysis just simply means news. The time that the news is going to come out. I don't care, because I don't really pay attention to if the news is going to move the market left or right. I just want to care about the time. At what time is this news going to drop? So if I have an entry prior to the time, I make sure that I'm risk-free on an entry rather than my stop loss is still there, because they could go for my stop loss and there could be slippages and all this other kind of things. So I try as much as possible to take care of those things. Those are the things that could affect, those are the things that news outcomes could affect my trades negatively, but NFP can come into my POI, it can react into it and it could go in my direction. It's happened before. TPI, it's happened before. FOMC, they've all happened before, so it really is just about the time when it drops and am I in a trade or am I not in a trade? That's what I pay attention to when it comes to news. Okay. All right, guys. So take care and let's have an amazing month. Cheers.